Good morning. It's September 11th, 5:09 a.m. Welcome to episode 17. Good morning to you, Wawi.
Good morning, Mark. How are you?
And good. And good morning to our listeners. I hope everyone had a great week so far. This is your host, Mark Yu.
And Wabi Santos.
Welcome to the Mark Yu and Wawi Show. A disclosure, this show is made for sharing information purposes only and not to be considered investment advice. We record once a week. I and Wawi are both physical therapists here in the USA with the same passion and interest in researching and investing our hard earned money in the stock market. The show's goal is to share and learn from each other, answer questions, and to our coworkers in the medical field, thank you all for your hard work. We are available in YouTube, Spotify, and Google Podcasts. On our previous episode, we discussed the ongoing economic slowdown observed not only in China, but also in Japan and Europe, and some economic sentiments changing here in the US. For those who have missed it, please feel free to go back and listen to it. All right, on today's topic, we got what's up with Wall Street, the different sentiments in the market, a couple of video clips from Wall Street interviews this week, and of course, our quote of the week from Wowie. So let's go ahead with our What's Up with Wall Street segment. This will be, of course, none other than the jobs numbers. So this came out just last Friday. It just shows how the America's economy is slowly recovering from the COVID pandemic. So we see here that the U.S. employers added 235,000 jobs last month in August, and the nation's our unemployment rate have fell to 5.2%. Also, the average hourly pay for U.S. workers rose 4.3% from last year to $30.73, which is really a good sign. So initially, Wall Street was expecting a really high number. It wasn't around 600, 700,000, but a great jobs miss for sure, missing up by over 500,000 in estimates. So the leaders and laggards in terms of hiring, uh, where the leaders are data processing and related services, they gained 11,900 jobs with current wage at $43.67. Also, the motor vehicles and parts businesses gained 24,000 jobs with current wage of $25 a share. Air transportation hired 11,400 jobs. So to the laggards, to the industry or companies that have reduced workforce, were the transit and ground passenger transportation, which lost almost 8,000 jobs, believe it or not. Transit and ground passenger transportation. I believe this why we probably because we're at that shift. I believe you've said one thing about it before, where there's a great adjustment in the uh, work
Yeah,
industry right now. So the
yeah, a great job reset.
yes. So the people, the losing jobs, I don't think they're just being fired or let go, because we're still opening. The economy is still reopening, and we're losing 8,000 jobs in transit and ground passenger, another 1,100 jobs in communications equipment manufacturing, water transportation lost 700 jobs, motion picture lost almost 4,000 jobs. So I think it's not just like them firing people. I don't believe that's an accurate statement. It would be some sort of a combination with people also, uh, quitting, as we could see here in the following chart. Like job openings just hit all-time high, as you can see in this chart. For our listeners, don't worry, it's just a chart that shows like from 2001 to this year. It's just slowly, up and down. But when COVID struck, there's a big dip. But after that dip, like the stock market, it just rose. Like it dipped to about 4,200 job openings or 4.2 million job openings during the pandemic lockdown. But now we're at, it just spiked back up, way up, like from 4.2 I estimate. Now we're at 10.9 million job openings. So businesses are looking for employees. And coinciding with that is the quits rate. We are also at the all-time high in terms of quits rate. Um, it's at 2.7%. So people or employees are, going off from their usual jobs and trying to look for a better placement elsewhere, or probably shifting to another industry now that work from home is, a little bit evident. So here, according to a Fox headline, it says job openings hit 10.9 million, fifth straight record high. So probably fifth month that we have hit another record high in job openings. From a Reuters headline says U.S. job openings hit record high as employers struggle to find workers. So this is pretty much self-explanatory. According to Jennifer Lee, senior economist at BMO Capital Markets in Toronto, she said, "This is a super tight job market. The ongoing struggle to find the right worker for the right role continues," which summarizes up the data that we have just seen. And the next segment, it says here, next article, it says here, producer inflation accelerated in August. As wholesale prices rose record 8.3% from a year ago. So what is producer inflation? So I Googled it earlier. Now it's not showing up. Producer price index, it's some sort of a measurement where purchase managers do their like estimates or sentiments in terms of here we go. Producer price inflation is a price index that measures the average changes in price received by domestic producers for their output. Its importance is being undermined by the steady decline in manufactured goods as share of spending. Regardless, it's an economic measurement um, that kind of reflects the inflation.
Mhm.
So we are at record, and it looks like, according to the CNBC article, this is the biggest increase on record going back to 2010. The move showed that inflationary pressures are likely to persist. What's more important on this is, as me and Wawi have already discussed in our previous episodes, we were, already saying that, kind of in the side that the Fed is really looking at this number closely because they're anticipating that during the course of time, this would still be transitory. But yeah, it looks like the data comes, as
Yeah.
it shows, and if it's just keep going like this, then the Fed probably would feel the increased pressure to taper, which is what Wall Street doesn't want to see, right, Wowie?
Yeah. So the Wall Street is kind of spoiled right now.
Mm-hmm.
The producer price index factors in cost of materials to produce something, and eventually the price of goods that's manufactured. Some financial analysts, I
Mm-hmm.
think, or um, experts will say that
Right.
the PPI is not a good indicator
Oh, okay.
for inflation,
Mm-hmm.
but I think it is because it comes at the forefront before prices really go up, because they're producing things and it costs more to
Right.
produce things. The other thing you look at is the CPI, or the Consumer Price Index, which
Mm-hmm.
is what we're paying for stuff right now.
Right.
So what this number is saying is that things are gonna go up more.
Right. It is kind of like correlated moving forward. So I think
Mhm.
if that's the case, someone needs to taper,
Yeah,
or because
yes,
if
that's true.
law of supply and demand, there's lots of cash buying a certain item, so there's much more demand. So that
Mhm.
could further increase the price. So the word that we're afraid of hearing is the early taper, which we
Yeah,
already expect by early next year. But maybe some point in time that could happen sooner, then that could might indicate a shock to the markets, which we already have witnessed this week. Like we have experienced 5 straight days of down. market this week so far, which we're gonna see in a little bit.
Mhm.
Yes, on our next article here, it says here, how far can S&P 500 stay up forever? It says, but I don't think so, because at this point of time, we just said, market is going down slightly a little bit, at least for this week. Not a horrible correction, not a drop, but it's been going down. So this is like a reflection or a replay of last week's data, where the Citigroup Economic Surprise Index has been trending negative compared to the stock market, which, over the course of time, since past 20 years, they've never been actually like one is to one, like correlated. It's not like, for example, back in 2017, the economic surprise index went down negative, but at the S&P 500 hold its ground at the positive territory. So it's not a clear indicator, but still it's quite a divergence that the surprise index has gone negative, and S&P 500 is still up there. So
Yeah, and the
this is.
market is
Mhm,
sensitive. We saw a correction yesterday, Friday,
mhm,
where tech stocks uh, trended down significantly
right.
after hearing news of increase in taxes
Mhm,
per Biden's statement yesterday
mhm.
about taxing buybacks.
Oh, really? So they're gonna get into the buybacks now. Uh-oh. So most of the tech
So
companies are actually playing that role right now, right? They have allocated so much cash for their buybacks.
yeah, and then the news yesterday about taxing those buybacks
Mm-hmm.
uh, affected the tech stock. So it's skittish again.
Mm-hmm.
I think it's waiting again for some good news.
Right.
But later yesterday, there's some news about um, some credits for EVs,
Mm-hmm.
trying to push back. Well, not trying to reinstall the 12,500 credit
Oh yeah.
for EVs.
Mm-hmm.
So that may change the atmosphere by market opening tomorrow for some of our EV companies.
Right.
But the market is skittish. It's
Mm-hmm.
like very sensitive right now to the news.
Yes. So for our listeners, buybacks, it's the activity that a company, a public listed company, um, engages whenever they see that they have extra money, to support their shares, or at least enrich their already shareholders. So buybacks is like they're buying their share backs. The term is share buybacks. So they buy their shares from the open market. They're gonna buy it by the millions, or by the hundreds of millions, or by the billions. As a result, there will be a lot less shares available to the investors. Therefore, the law of supply and demand. So if there's a lot less supply of shares, then therefore, um, technically their stock price should go up. Also, it helps them improve their earnings per share, because earnings distributed to a lot less shares would entail higher earnings per share, which would give them higher earnings per share estimates, which Wall Street would like eventually, and appreciate their shares further. So I think another fact,
But
that's not included in the window here in our
mhm,
articles, is Apple also has been declining for the past couple of days. Primarily because, well, now, yeah, I think like yesterday, Friday, Huawei, I think one of the courts ruled that Apple needs to allow their app, like software developers, to charge, not just through the app store or their payment system. So I think that sent a blow to Apple's software developing software segment.
yeah, so
And
that's gonna slow down their their growth.
right, a little
Um,
bit, slow down a little bit, because I think I saw an article where they just reported, I mean, billion is a number. Like, one of the analysts said it's gonna hit Apple $1 to $3 billion worth in revenue, if in case like the certain scenario plays out. But the thing is, Apple generates 300 something billion dollars in revenue a
mhm.
year, or I think a quarter. Yeah, for 3 months. So that's like peanuts for Apple. So But Apple, I noticed
Well,
in my portfolio has been going down lately, and that affects the market because it's the largest tech company that are out there, 2.1 trillion, I believe.
yeah, we'll see how that chain
Hmm.
affects Apple as a company as a whole.
Right.
Um, we'll
So
see. We'll see the chain reaction.
yeah, but I think it's all for the better. They'll be open to other software developers, and more probably it'll facilitate more development in that field. So next chart we see here the buy the dip mentality. So retail investors have been buying the dip, as observed in this chart. It's been ever increasing since the COVID lockdown, according to this Bloomberg article. According to Nicholas Pani Panigurtzoglu of JP Morgan Global Strategist, he said, retail investors have been buying stocks and equity funds at such a steady and strong pace that makes an equity correction looking rather unlikely. Whether the Fed, whether the coming Fed policy changes retail investors' attitude towards equities remains to be seen. So as long as the retail investors are happy, looks like we're gonna be on the safe end. And I guess for this week is a little bit of an exception because every day of this week the market rallied kind of, but it faltered in the end. So it might have frustrated some of the retail investors.
Well,
According, Mhm.
seasonally, September is a low season,
Oh, that's true.
uh,
Yeah.
based
Mhm.
on historical patterns.
Right.
So this is probably just following that pattern.
Right. A minor blip, hopefully. Oh yeah,
Hopefully,
and that reminds me of our episode last week. Tom Lee saying that in contrast, he's optimistically bullish for this September. Interestingly, because he said that investors already positioned, retail investors already have been selling stocks prior to September, but it looks like it's still playing out as such, like a weak performing month. Bank of America Subramanian dumps dire S&P 500 call after big rally. So this is a well-known analyst there in Bank of America, much followed. Like she finally surrendered to the equity rally, and but he changed her projection from 3,800 for the S&P 500 to 4,250. But the stock market is already way up than those targets. Calling it as such, it would indicate a 6% decline by the end of this year. She said that we see little to get excited about. This may not end now, but when it ends, it could end badly. So she's showing that bearish sign, which we're gonna look at closer, in terms of Wall Street sentiments in a little bit. So this is another article fresh from the Open from yesterday, entitled "Big Up Days Are Gone as Correction Hit Half of S&P 500." So for jargons, correction means 10% drop in price, regardless of what stock that is, or index, or market. It just entails a 10% drop. So it says in the title itself, half of the S&P 500 stocks. These are the largest 500 largest companies. 250 of them already are down 10% on average. So it says in the article, big rallies are a thing of the past. The S&P 500 has gone 34 days without rising 1% in any of them, the longest in 20 months. Um, so, in the more than half of the index members, as we've said earlier, have declined at least 10% since May, according to Morgan Stanley. It's worse in small caps. Small caps, I would say, less than 100 billion um, in market value. Where in small caps, 90% of Russell 2000 stocks, almost all of them, already suffered 10% down in stock price. Um, According to Phil Blancato, Chief Executive Officer of Ladenburg Thalmann and Company, he said that it's the next 6 weeks in the market that I have the greatest fear of. So fear, the word
hmm
fear is now being brought up. The market is at a bit of an ebb tide. So market is ebb and flowing, ebb and flowing. So now we're looking at some sort of like pullback a little bit. So another quote from chief strategist at Principal Global Investors, Seema Shah. The person said, the fundamentals are still extremely supportive. Financial conditions are very easy, he said. We're looking at a new phase in the business cycle, or at least the next stage of it. We've got markets inevitably in transition, and this is a time where you have to be really, really careful which companies you're investing in. What do you think about these quotes, Awi? Some sort of like bullish, but not so much bullish anymore. Like you have to watch out your investments, and we
Mhm.
probably are in the ebb tide.
So we're kind of at the hold right now,
Mm-hmm.
right? So buying, and now people are holding,
Mm-hmm.
and I wonder how many are selling. Um, mm, Loss is not yet significant
Right.
for the markets, so people are holding. Investors are holding.
Yeah. I. Mm-hmm.
Speaking of holding, one of the major index that held the line was Nasdaq,
Mm-hmm.
but you see I think quite a bit of correction yesterday, Friday. You
Right.
saw correction there on the Nasdaq.
Right. That.
So that's a clear sign, since S&P 500 has been trending down.
Mm-hmm.
Now initial signals of Nasdaq going down. So people are holding right now, holding the
Mm.
line, waiting for news,
Right.
waiting
Probably.
for
Mhm.
reassurance, I guess.
Probably also a much deserved correction coming up pretty soon, right, Wowie? Because we've been, discussing the ever so increasing stock market. So
Yeah.
at least at this point of time, like what Morgan Stanley, an analyst here, Mike Wilson, chief U.S. equity strategist at Morgan Stanley, he said this rolling correction will end with a consolidation in the higher quality leadership areas of the market. We think that finishing move will happen in the near term, and that it will lead to a benchmark level correction of 10%. So I think
Yeah, a lot of
as Mhm.
experts agree that we are due for a correction.
Mhm.
With the Schiller ratio at 31 right now for the
Right.
S&P 500,
Mhm.
they keep insisting that we are due for a correction.
Yeah.
But that's normal, right? So
Yes.
uh, don't be scared or panic.
Right.
Uh, the fundamentals are still okay.
Exactly.
It looks like so.
Yep.
So just think about insurance. You know, what are you doing to
Mhm.
insure your investments?
Right.
Um, are you shifting some of your investments, Mark, based on these news?
Yeah. Well, currently I'm still holding, trying to build a cash pile just in case the market further drops. Like what you said, it could be another just part of the stage of the cycle where we're just going down a little bit, and overall we would be provided a good buying opportunity, and then come back and then further improve our position, or probably just add more to our high conviction picks, like what
Mhm.
the experts are saying, stick with the big ones, or the better sounding companies. That way you don't experience like a significant drop in portfolio value. Like, for example, the small companies are now being tested. 90% of them are down, and the S&P 500 for sure is also down, half of it. So like you just said, Nasdaq held their ground until yesterday. Until like for the start of the year, until today, until yesterday, Nasdaq is still up 21.6%. Not bad. Um, Compared
Mhm.
to the Dow Jones, which is just up 14.5%. Dow Jones Industrials, I think, these are the reopening plays. So the reopening story probably has slowly died down a little bit. S&P 500, even though half of their components or companies are down by 10%, overall the index is still up 20%, 20.48% to be exact. So there's still some ways. It's not like it's all going downhill from here, but we could.
Yeah, that's why
Mhm,
Friday
mhm.
yesterday, and I keep saying Friday because Friday was the main signal
Right.
for mid August to mid September. Friday was the signal for me to go ahead and look at my positions.
Hmm.
And like you said, you did some, uh, you positioned some cash into your investments, and that's what I did yesterday too. I looked at my holdings and looked at the ones that are ripe for harvesting,
Hmm.
and I think I did like a 1% increase in my cash holdings
Oh, okay. So you
from
liquidated a little bit.
yesterday.
Hmm.
A little bit, and I'm just kind of trending. I don't know that if that's the right way to do it, but looking at what the trajectory might be, looks like we're up for a correction. But we keep saying that
Hmm.
last year, early this year, we were thinking that there might be a correction, but it didn't happen.
No, didn't.
But but I think we're overdue, right?
Right.
We'll see.
Definitely.
We'll see.
Now it could be, according to Morgan Stanley, they said that it could be a rolling correction. So it could happen within a couple of days, or weeks, or months. But yeah, like you said, yeah, I sold most of my stock investments like December of last year, thinking that the market would drop. But come to find out now, at this point in time, I know hindsight is 2020, but I missed a lot of that upside for sure since the start of the year. But now, yeah, I've been trying to stay in the market as much as possible. So yeah. So on this chart, it shows here the Hang Seng Tech Index. China has been on all over the news. They've been recovering. Actually, believe it or not, from August they almost rebound by or bounce back up by 20% just yesterday, up about 17%. This 3% shy to 20%, which would indicate a bull market, but the market dropped down a little bit because of certain regulations being announced again regarding the tech industry, which hit Tencent and other tech companies in the land in China. So contrary to this market reaction, we've been seeing a lot of flows to mainland Hong Kong, a lot of money coming in despite the drop. So the bounce from mid-August, like I said earlier, is clearly supported by the outstanding inflow of money in mainland Hong Kong and Shanghai Composite as well. They're now bouncing back up to near February highs. The index comes within a few points of new 6 months high. So some life being brought back to China and Hong Kong at least. Well, according here to Morgan Stanley analyst, this is Robin Xing, dated September 7. He said, "We think it is in China's best interest to thrive as an economic superpower, which will likely hinge on private led innovation and foreign investment in the face of a structural savings decline amid an aging population." So it's kind of like it's quite quite deep, but I guess overall he's still optimistic with China. And one more thing about this, we've been seeing lots of flows into China, but believe it or not, also while I saw like this in a Bloomberg article the other day that the Chinese companies, Xiaomi and Tencent, um, specifically, are buying they're buying a lot of their stocks, large buybacks, according to data compiled by Bloomberg. Xiaomi said here, Xiaomi has bought back more than 5 billion Hong Kong dollars of its shares since July, since they've dropped. So they definitely bought in when the market was dumping their shares, a total of $643 million. And Tencent conducted 13 buybacks since August, since its earnings in August, spending 1 billion Hong Kong dollars. So definitely people that are buying now the Chinese shares, you're not the only one. Companies themselves are buying it. buying their shares back because they think it's cheap, or probably they have the extra funds to do so, which could reward their already shareholders at this point in time. So a little segue. Well, we see here an interesting chart. Used Rolex watch all-time high. So it says here that the number of sales hasn't really changed since 20, well, early this year. But as of which, like, in comparison, like used car sales or used car prices is all-time high. Used Rolex watches too have hit all-time high. Now at 16,000, no, at least $12,000 per watch. A
Yeah,
random fact.
that's a good signal too. Did Rolex cut down on their production, or
No,
is this just
yeah, that's actually a good question because I've been looking at some Rolex watches since last year, since the lockdown, and there's just no way to get in an order now. Like if you want to buy a certain or a certain model, you can actually tell a Rolex dealer, but they are not even taking orders at this point in time because
Mhm.
their orders are so backlogged. For
Yes?
a Rolex usually is developed within a 1 year time frame. A Rolex takes a year to develop, and there's usually just one person or engineer working on that watch. So it's
Mhm.
like very critical. It takes a lot of time, but orders are now have like been like the wait list is so long. They had to wait for years before you get your Rolex watch. That's why people cannot wait. There's demand out there. People have the money, so whatever is listed out there in the used Rolex watches, there's a heavy demand for it. So it's ever so increasing, all time high, as you can see there in that chart.
Yeah,
So,
and
mhm,
probably Rolex is not the only one that's seeing the increase in demand.
right,
Um,
luxury items looks like.
luxury items
Mhm.
are hot lately. Well,
Mhm.
it's been growing a lot this year.
Yeah. Uh,
Especially Louis Vuitton has
Louis
really
Vuitton, yeah.
skyrocketed.
Maybe Hermes or Prada. I'm not sure of those brand names, but
Mhm.
sounds exotic. Whenever it sounds exotic, it could be a luxurious item.
Yeah, they're
Uh,
sought after.
Heavily sought after for sure. That's right. So yeah, now on our next slide, it's an article from Market Watch, published yesterday. It says here the $1 trillion that has flowed to global stocks in 2021 is bigger than the last 20 years combined. Oh wow! So this, if not, kind of signifies how people are now piling into the stock market. This is the
and how
largest record. Mhm.
the government has piled into the smart stock market.
Indirectly, because they're providing stimulus checks and all these and not tapering, but all this support, monthly support to different parts of the industries, like the airlines, for example, loaning money to them by the billions. Yeah. um just look at that chart. $1,048,000,000,000 have flowed into the stock market just this year. um Largest inflow on record. Whew. Lots of money
So
in the stock market right now, Awi. Lots of money.
the financial sector should do well by next year.
Hmm.
Um, a lot of asset buying and a lot of credit and debt.
Right. We're gonna leave that there because it's only from this point in time. Hopefully they keep their money in there and not start liquidating, or because that would indicate the selling pressure over time. So this is an article in September 2, from the same publisher, entitled "Robinhood Investors Are Propping Up the Stock Market." So this kind of like rhymes with the previous slide that we have discussed, that retail investors are buying the dips. This is just saying that the market is heavily supported not just by the Fed, but also with retail money, with the Robinhood investors specifically at this point in time.
Yeah,
So this
and by
gives a
market
face.
makers too. You
This
know,
gives. This gives a face to those retail investors, primarily the Robinhood ones, which are mostly millennials, as we have already known. The meme
Mhm.
investor, meme stocks, according to the same analyst that we have mentioned earlier, Nicolaus Panigratslu. Sorry for massacring his number, his name. He said, "What could cause an equity market correction, which we may already be experiencing at this point in time?" This is September 2, which is about 10 days ago. This question is admittedly difficult to answer, according to him. So far this year, retail investors have been buying stocks and equity funds at such a steady and strong pace that makes an equity correction looking rather unlikely. So, not so long after, we're already downtrending. So, we're time and point. We need to look at the sentiments because this would indicate how the market or how the investors are looking at the market. So fresh from the oven, as of yesterday, the fear and greed index. We're now back in fear. While we look at that, just a week ago, we're actually hovering at neutral in the 50s, and we're rejoicing because we've been hitting all-time highs, but we were at fear. But it didn't last long, looks like. The neutral sentiment shifted down to fear at this point in time. Fear and greed, look at the spike from last week, and now we're back down to the 40s. 34 to be exact. So we're definitely down a little bit bearish at this point in time. And now the AAII investor sentiment, where they ask the American investors group, what direction do members feel the stock market will be in the next 6 months? So from September 1st, we're at 40s. We breached the 40% mark last, just a week ago. Now we've dived down again below 40. We're at 38.9. From 43.4, we're down to 38.9%. So a little bearish sentiment. And believe it or not, some of the bearish investors actually got fewer. From 33.3, there wasn't any rise in bearish sentiment. They went down to 27. And much of them shifted to neutral, which is now higher than the historical average. So some of these investors are now on the neutral side. They're not sure what's going to happen. Well, it's hard to predict, but this survey some sort of serves as a backbone in terms of sentiment. So interestingly, more people are getting neutral at this point in time compared to the historical average. The volatility index, Huawei, is now increasing. It has increased 11% just in the past week. Now we're at 20, almost 21. And for the past month, we've gained 30%. So volatility is up, markets are down, but panic is not in sight yet. As we've seen here for the past 6 months, we are just trailing through the average of 20. So nothing to panic about, nothing to get short-sighted, blind blindsighted,
Yeah,
blind side.
so
Mm-hmm.
it's symbolic that we're looking at this today, which is 9/11.
Oh yeah.
We
Mm-hmm.
know that the United States is resilient
Mm-hmm.
amidst all trials and
Right.
tribulations,
Mm-hmm.
including its economic standing
Yep,
nationally and globally. So
that's
um,
true.
even though these sentiments are showing some bearishness,
Uh-huh.
just know that we are intrinsically motivated, to make things happen
Yes.
and to make our lives better. This is still the nation of dreams
Mm-hmm.
and dreamers. The American dream is still alive
Right.
and well.
I agree. 100% agree. Most resilient economy in the world. Um, yeah. Going back to the sentiment, Bitcoin. I'm not sure. You're tracking this, Wawi. So you gotta share some
Oh,
information
okay.
to us. So I can only share whatever I found here. The sentiment part. They're back in
Mhm,
fear. Bitcoin sentiment, believe it or not, from last week's
mhm.
greedy 72 It's down
mhm.
to fear at 31. So any updates on the Bitcoin or crypto side? Wow.
Yeah, so since El Salvador took
Mm-hmm.
Bitcoin as their legal tender, the cryptocurrency market has trended down.
Mm-hmm.
Um, Ethereum is actually holding its own
Mm-hmm.
uh, compared to Bitcoin. Ethereum is holding its price.
Mm-hmm.
So now we're seeing that there are three trending higher than Bitcoin. That would be Tezos. On this is on my radar. Tezos, Cardano, and Ethereum.
But would you think that the El Salvador buying Bitcoins signify the market top? Or is just
Mm.
a consolidation phase? What do you think about that?
Probably a consolidation phase,
Mm-hmm.
but I'm a crypto bull, so
Mm-hmm.
so I'm biased on this. But looking at the trend, with the adoption rate of Bitcoin,
Right.
initially by public companies and now nation state, and
Right. A
then
country. Yeah.
yeah, that's a whole country adopting it.
Mm-hmm.
Uh, and and there's other countries that are looking into Bitcoin
Mm-hmm.
uh, as a mode of transaction.
Right.
So
Mm-hmm.
so we're gonna see a consolidation, in my opinion, and some experts are predicting that uh, Ethereum, for one, may double by by uh, well by next year. But these are all assumptions. All I know
Right.
is that Ethereum has a programming language there that they can use for transaction.
Mm-hmm.
Bitcoin is just like gold.
Mm-hmm.
Uh,
It's like a commodity.
it's a commodity based on energy usage
Right.
and proof of stake.
That reminds me of
I mean, proof of
mhm.
work,
Remember,
and
right.
Ethereum is proof of stake.
And I think just a couple of months ago in our early episodes, I remember us discussing about the central bank here should be coming out of something about their central CBDC, right? Decentralized coin. Well, we haven't heard from
Mhm.
them.
Well,
Maybe
what I've
before
been
the end of this
hearing,
month.
yes, what I've been hearing is that they're studying the stable coins.
Mm-hmm.
So you're looking at USDC, USDT, these stable coins that are pegged to the US dollar.
Right.
So
So
they're looking into the risk benefit of its use here in the United States.
yeah, that's interesting. Hopefully, because I know he mentioned the month of September that they're gonna come out with a, what do you call it, a report in terms of that part, the CBDC, because China is definitely way ahead. They're already using their own kind of like country's stable coin or something like that. But I'm not 100% what they call it. uh, yuan. I don't know. We'll take a closer
Yeah,
look maybe next time.
the digital yuan.
A digital yuan. That's what they call it. Yeah. So US has
I don't.
some catching up to do.
Yeah, probably a lot of catching up to do,
Yeah.
but I think the U.S. is more cautious and
Hmm.
conservative about looking at all of this. So they're looking at potential regulations for the stable coins in cryptocurrency,
Hmm.
and definitely hearing a lot of news a
Right.
few months ago about studying uh,
Stable coins.
the CBDC digital currency for the United States. But I
Right.
think that's where we're gonna go,
Hmm.
and the pandemic just hastened that course
Right.
for the United States.
I think once their study comes out, then I definitely pay attention to it, and then maybe that's the time I change my mind of uh,
Mhm.
getting exposed to the crypto world. But yeah, going back to our sectors for the past week and this year's performance. So you know, last week on our podcast, we were looking at some sort of like a diversification in terms of being up and down, certain industries being up. This week is certainly a change in mood. All of the industries are down. Believe it or not, real estate, as soon as as recent as a couple weeks ago, real estate was outperforming on a week to week basis. But this week's a bad week for him. It's the worst performing sector in this week's performance, followed by industrials, utilities, and energy, financials as well. So these are reopening stocks as well as the ones that would benefit from higher interest rate. So I think it's just because of the higher, higher inflation purchase price index and fears of tapering adjustments. The scheduling of that kind of affected the overall sentiment in all of these industries. Well, broadly the market. But for the past month, technology is the best performing still. Technology, the big
Mm-hmm.
tech. Worst performing are the energy sector, oil, and basic materials. But year to date, broadly, we're still up. As we've discussed earlier, 20% up for the S&P 500 and Nasdaq. For the best performing industry since the start of the year is the communication services, which would include the big tech, Google, Facebook, Disney, Comcast, Netflix, Verizon, AT&T. So some of the big tech, but not like Apple. But yeah, Google, Facebook, Disney, Comcast, Netflix. These are the big ones in the communication services industry. They are the best performers since the start of the year, and believe it or not, followed by energy and financial. I think since June, Huawei we've been going downhill for energy and financial, but at this
Mm-hmm.
point in time, if you're a long-term investor, you're still probably up with you investing in oil and banks.
Mm-hmm.
So at the flow, which Bank of America releases, this just came out a couple of days ago. So weekly flows looks like flow has stayed in the tips, the Treasury inflated protected securities. Investors are still quite wary of the inflation, which they have the right to be, because inflation has ever been slow and steady going up still, as reflected to the purchase price index that we have just discussed. Investors piling money in utilities. Uh, they're selling out of energy, which is sad. I have Chevron and Exxon in my portfolio.
Mm-hmm.
MLPs, for those who are not aware, these are like the oil companies as well, limited partnerships that provides good dividends, money outflowing from energy and the limited partnerships. Even dividend, look at that, outflows from dividend uh, segment of the market, which is interesting. So now we're gonna play a couple of interviews. You ready, Wowie? The first one is no, the
Kathy
from
Wood.
Kathy Wood, yeah, widely known to the investors. So we'll just roll the clip. This is Kathy Wood interview with CNBC.
if if regulators get together and agree on what exactly these cryptocurrencies are, how to define them, that will be a good thing. Just certainty will be a good thing for this ecosystem.
Really underlying the move higher in Robinhood's shares, Coinbase, crypto markets, is that rise of the retail investor, Kathy, and very much you have a loyal following of those retail investors. Looking out over the next few years, how important will the rise of the retail investor be, and how and where the market goes from day to day?
Yeah, I'm going to give a shout out to Tom Lee from Fundstrat. He picked up on a study that Stan Salvicson, who was the chief strategist of Merrill Lynch in the 80s, when I was just coming of age in this market. Stan had a hypothesis that the baby boomers would make for 15 to 20 years of a bull market in equities. And that's what happened. It was a very simple assumption, and it played out beautifully. Tom Lee, I don't even think he referenced that study, but has taken the notion that millennials are the reason we're in a bull market for equities, and that this leg of the bull market won't end until 2026. And I think he thinks that the bull market, with some fits and starts after that, could actually extend to 2038, I believe it is, which is the year that the number of millennials peak. So this is the echo of the baby boom. I lived through the baby boom years and that equity market move. It was magnificent. It was a very simple assumption, and it worked. And I do feel we are in the same place now.
Kathy, too, lastly, before I let you go, just given everything you've achieved in financial services, the following you do have, how do you feel when you hear there are people or short sellers betting against your funds?
Well, what I think two things. That's what makes a market. And, we're all going to have different points of view based on our own research. So I like the fact that, markets are being made around this controversy, and we want the controversy to be out there. What I found for years is innovation was avoided. And whether it was research or investing, there was less and less of it as our markets moved into more benchmark sensitive territories after the tech and telecom bust and then the 08-09 meltdown. So much so that analysts and portfolio managers felt they were taking a huge risk investing in a stock that was not in an index. Well, guess what? A lot of innovation, which is all about the future, is not captured by indices. In fact, very little of it, we believe, is captured by the indices. And so I felt starting a business on that premise to focus exclusively on disruptive innovation would become productive. And it has, because we have never been in a period ever in history where we've had 5 major innovation platforms involving 14 different technologies, all moving into S-curves, the S-curves feeding one another. We're in a period of explosive innovation. And so, I think that as more and more investors and analysts do the research that we're doing, and we give our research away, we're happy for anyone.
I'm a subscriber. I've signed up.
There you go. There you go. So thank you very much, Brian. But we feel one of our missions and values is to educate, because we feel like there's been a dearth of education in the financial markets around innovation because of this backwards looking, benchmark sensitive style that evolved out of 2 crashes. So many people ask me, are we in a bubble? We couldn't be further from it. I do not believe that investors, the average investor, shall I say, understands how provocative these next 5 to 15 years are going to be as these S-curves feed one another and enter exponential growth trajectories that we have never seen before.
We greatly appreciate you giving us some.
Whoa. Comments, Wowie.
Wow. Well, breath of fresh air, right? She's against the wave.
Mm.
So most of the stuff I've been reading is quite different from what Kathy Wood is saying.
Yeah.
But she has, thinking about this, she has some basis, right?
Mm-hmm.
So if you look at the average age of the investors right now,
right.
It said that it's 35.
Mm-hmm.
And then and then some of them are my age, right? Born during 1969, your Gen X people. They're probably just now catching up with the investing technology.
Right.
Now that it's accessible for most people, Gen Xers like me can get involved in active investing.
Mm-hmm. With the technology nowadays, Robinhood and other brokerage firms, it's not just Robinhood. Like what we have already been discussing, like from the likes of Morgan Stanley, JP Morgan, identifying retail investors being the support of the market. She, on the other hand, pulled up a study where millennials could support this market even until 2026. She said on
Yes.
this, believe it or not, listeners, this interview has just been held like 5 days ago, September 6th. It garnered about 18,000 views. So going back, I mean, it's always good to be optimistic,
Mm-hmm.
and the way that she described it, I think, it makes sense. I mean, we're gonna have fits and starts, but
Mm-hmm.
the as long as the millennials are happy, and now that they're enjoying the luxury of finding their own jobs, quit rates at all-time high, it's bad. It's a bad chart for a business owner, but you gotta give what the employee deserves. You gotta raise the salary, for them to stick with you. And
Mm-hmm.
as like she said, it could even go until 2038. So that's like decade away from now, like the bull market. That's incredible.
Mm-hmm.
And the
So
way,
there's a lot of technology
yeah,
pushing this forward.
right.
Its implementation will determine the trajectory of the economy.
Mm-hmm.
Robotics, AI,
Yeah.
fintech. Fintech, I think, is at the tip of the iceberg right now,
Mm-hmm.
with IT companies going into the fintech realm,
Mm-hmm.
becoming banks. We have
Yes.
these cryptocurrencies
Mm-hmm.
that actually has some case use.
Yeah.
So you have this big ocean of technology,
Mm.
saying that this is the future and we
Right.
can monetize this.
The thing
So
is, yeah. Mm-hmm.
yeah, so I would like watch this, right?
Mm-hmm.
there's no there's no other way but to just ride this wave.
Totally.
It if you look at technology, you really would see a bullish future, right? You would see, and it's already happening. And the best example would be Amazon,
Mm-hmm.
uh, pushing pushing the limits of
Right.
technology,
And
clouds, robots, everything.
now that you said robots and robotics, it makes me think again of the printing age. When they said that they're gonna start using computers, and people fear that jobs will be taken and there's gonna be no replacement. There's just no, you know precursor to that. People will still find ways to find jobs and be productive. So I think
Hmm.
the only way from here is still, economically, we're gonna still grow. So that's a good sign overall, regardless what
Hmm.
the market sentiment is, as long as you stay invested. So that's the bullish part. Now we're gonna tackle a couple of interviews, which is fresh from the oven as well. A couple of days ago. It's this is earlier. Correction, it's not from CNBC. It was from Yahoo Finance. This is an interview from a different analyst here in CNBC. Interview is entitled "Should We Expect a Market Correction Soon?" All right, the bearish sentiment. 33,000 views as of September. The video was published on September 9th. So let's just roll the clip.
The negativity is certainly building, so you can understand why people are getting a little bit cautious or nervous. What is it, this week alone? What are we, Thursday? Goldman cuts the growth forecast this week. Morgan Stanley downgrades U.S. equities to underweight. Deutsche Bank says expect a significant pullback. Somebody grab their phone before the rally comes back. Bank of America, Savita Subramanian says it might not end now, the rally, but it could end badly eventually. So, okay, I'll ask you this, Josh. Is it time to get negative, or is it time to say this too shall pass?
I think it's time to say, I hope they take them down, because market is plus 18% year to date. And I probably don't have as much stock as I want to if this rally is going to continue. It's the only rational mindset, unless tomorrow is the day that you're cashing out your portfolio. So I really don't see a problem with us having some sort of September or October tremors. Like, that happens all the time. I'm rooting for it. It's a better opportunity to buy than higher prices, and nobody should be shocked by that outcome. On average, we're off 10% from highs every 18 months or so. So, like, nobody should fall out of their chair if and when that happens. The thing that causes it, or whatever cause we assign to it after the fact, will probably be something scary, something like the Fed made a mistake, or the move variant, or whatever you want to say. But it's those times that we say this too shall pass. So I think there's always risk every day we wake up. I know that might not be the most satisfying answer, but strategists have been putting out notes about the potential for a correction every month of every year of every decade forever.
More recently,
and
too.
that should not dissuade people from being invested.
Doc, I mean, part of the issue.
Well, I'm gonna cut the interview right there. Looks like we're seeing some sort of being conservatism in terms of the market at this point in time, which is currently reflected as well as of the past week. So what I'm seeing here, Wowie, is like experts are already seeing some trepidation in the market. They're already anticipating for a correction coming. While it is being supported by the retail investors, at least. So I think there's a healthy dose of bull and bear in this market. It's not like back in the tech boom where people are, just diving into the companies that doesn't have even any fundamental reason to exist besides from having a domain website. This is during the tech boom, 2000s. Which kind of reflected during the SPAC boom early this year, which clearly end up in a bust. But yeah, I think there's just a balance of healthy dose, right? Would you agree, Maui?
Yeah, so it's like a tug of war between the bulls and the bears.
Yeah,
There's still quite a bit of support, coming from retail investors.
for sure. Yeah.
But they're being questioned. Market makers are being questioned about their, flow rate. What do you call this? Transactions with like Robinhood.
Yeah,
So
the order flow.
yeah, the order flow
That's
rates.
that's how Robinhood generates money. It kind of conflicts. Some people say it kind of conflicts their kind of service to their customers. But yeah, so here's another video from the same day. Looks like CNBC is trying to like share the the negative side of things, the bearishness of the market. So this is from Leon Cooperman. It's entitled "Why Leon Cooperman Has a Weary Eye on the Market." We'll just roll the clip.
Legendary investor Lee Cooperman is the chairman and CEO of Omega's family office. And Lee, I think the last time I talked to you was the beginning of July. So we're going back a couple of months here. At that point, you said that you were a fully invested bear. Are you still feeling that way?
Absolutely. I would say that the cyclical conditions are not ripe for big decline. Generally big declines come about because of recession. We're coming out of one, we're not going into one. We have a hostile Fed, which we don't have. I think I'm critical of the Fed. I think they've been too easy. I think they're wrong on inflation. 65% of a typical business cost is labor, and labor is not going down. I think the transitory part of inflation is some of these commodity costs. And I think, you look at the world, it's kind of upside down. If you line up 100 economists and ask them what is the potential real growth of the U.S. economy over time, the response would be centered around 2% real. If you're a bear, you say 1.5. If you're a bull, you say 2.5, but around 2% real. We're growing at 3 to 4 times potential, yet we're persisting in holding interest rates at near zero. Okay. The second observation is we've already injected in the economy $1 trillion of stimulus in excess of wages lost. And our big government president is trying to get another few $1 trillion approved, which I don't think he'll get approved. So we're pulling demand forward, and I think this has created an artificial situation. There's nothing that's overpriced against interest rates where they are today. Well, there's some things overpriced. They're crazy. I call that the Robinhood market. But by and large, most companies are not overvalued. I went back and I looked at the excesses of 1972 and the excesses of 2000. And you're talking about totally different multiple structure than we have now, much higher multiples, and interest rates were over 6% in 10-year governments. You have a 10-year government at 1.34. There's nothing overvalued. So that's a cyclical view. But long term, I think we've been eating our seed corn. We're pulling demand forward, and I have a lot of things that concern me. I don't like it.
That's an argument for being invested right now. What would actually change your tune? What would make you say, okay,
I'm
time to get
listening
out of
to Fed speak, listening to Fed speak. I'm looking at inflation. I'm looking at market action. I'm looking at the gold, actual gold and Bitcoin, the dollar exchange rate and interest rates overall. I'm watching a lot of things for a signal to change. And then the market structure is broken. So when there's a real fundamental reason for the market to go down, it's going to go down so quickly your head's going to spin. There's no stabilizing forces in the market now. It's all run by machines. So, I would say those are things I'm watching, mainly Fed speak, inflation. Like I said, 65% of business costs are labor, and labor is not going down unless you're going into a recession. And we're not going into a recession anytime soon. And that's at least a year away, maybe longer, who knows? And that's kind of my story. Nothing's changed. I'm finding a lot of things to do in the market, which is encouraging. My biggest position is a very contrary view. I came into the year with overweighted energy. I'm even more overweighted now. And I look at the natural gas situation, storage levels are, way below historical norms. And the price of natural gas has moved up quite dramatically. And we have about 7 or 8 companies in the natural gas business that are coining money now, generating enormous amounts of free cash flow, paying down debt, paying out big dividends, buying back stock. 2 of my favorites, Tourmaline up in Canada, Paramount up in Canada, Cabot Oil and Gas in the Marcellus, and Devon Energy Transfer, Enterprise Products, 2 MLP type companies where they're paying big dividends. Pioneer Natural Resources. So we have a very big exposure to energy. And then I find a lot of individual stocks that are very cheap. Citibank at 9 times earnings and discount to tangible book value. Cigna buying back a lot of stock, 8.5 times earnings. Athene, merging with Apollo, 7 times earnings. And then I have the standbys, Google, Amazon, Microsoft, Facebook, Fiserv. I'm very high on Fiserv. And it's a 20 multiple stock that deserves to be selling at 25 to 30 times earnings in today's market. So, and my favorite idea is very ironic, is a bond. I think bonds are totally mispriced. If you look at bonds, it's really amazing. Historically, a 10-year U.S. government bond is yielded in line with nominal GDP. Okay, nominal GDP on a trend basis probably 4%. This year probably be 6 or 8%. Rick Reeder, who I have a lot of respect for, is on the program. He can talk to the bonds. But we're talking about a big negative interest rate in the 10-year and the short-term paper. I think it's a bunch of academicians, running monetary policy around the world. This negative interest rate stuff is ridiculous. The idea of buying 10-year German bonds and getting invest back in 10 years and you give them today, I don't get it. I really don't get it at all. And I'm saying that my favorite idea is a bond, but it's not an investment grade bond. It's a triple C bond. It's a company called Legato. They have first lien paper, 15.5% trading at 97. I think it's just very attractive, a little complicated, so I won't take too much time talking about it. But I find a lot of things to do, but I must say I have a weary eye on the market. I don't like monetary policy. I don't like fiscal policy. I don't like the attack of the wealthy. And it's not because I'm wealthy. I'm giving all my money away, so I care less. But, I'm a capitalist with a heart. And I think that this constant attacking of wealthy people is very disturbing to me.
Mm-hmm.
There's a
Now
lot.
that's
Go ahead, Bobby.
looks like he put some sense into the market with his statements.
That's a lot to unpack there. The guy is like, according to this Google search, Leon G. Lee Cooperman is an American billionaire investor and hedge fund manager, chairman and CEO of Omega Advisors, New York-based investment advisory, managing over 3.3 billion in assets under management. So this guy says that he's been bearish since summer or whoever. We discussed one of his quotes, like when the market's gonna go down, it's gonna make your head spin. I remember that quote. I think he gave that quote back in May or even early this year. The thing is, even though that he's bearish in the market, he's bearish on the federal monetary policy, the inflation that they're saying is going to be transitory, the guy is invested in the stock market.
Yes.
So like he just said, like he's overweight in energy at the start of the year, even more overweight now, which we could actually dissect some of the companies he mentioned, like some natural gas companies in Canada and here in the US, some MLPs, limited partnerships that he mentioned that we just saw that had a good amount of outflows this week. So there could be some opportunities there as people try to dump their MLPs or energy stocks. But
Mm.
ultimately, this guy has been like saying one thing, like being negative, but still keeping his money, which invested in stock market. And now he's saying he's also invested in some bonds, which are quite more technical and advanced for some investors. But yeah,
Those are like your insurance stocks, right? Energy, bonds. So it's good to get some insurance just in case the market reverses.
I think that's his point there, being exposed to the market regardless what's happening at the background, the noise, the policies, whatever. And he
Keeping it real.
yeah, keeping it real. And also he mentioned that he has his standby stocks, but no other than the big tech, Microsoft, Google, Amazon, he's still like bullish. So I think overall, regardless what the sentiment is, it's better to be exposed in the stock market rather than not. So before we end, Wawi, do you have any quote for the week for our listeners?
Yeah, so this is from the Bible,
Mhm.
Philippians 4, verse 6. Do not be anxious about anything, but in every situation, by prayer and petition, with thanksgiving, present your requests to God. So, whatever it is, bullish or bearish,
Right.
do not be anxious.
Do not be anxious, or at least try to decipher what emotions you're feeling and don't get carried
Mhm.
away. Because we've been
Mhm.
always discussing looking at the market sentiments. That way it kind of serves us as a guide what people are, what their mood is about the market. That way we kind of like see through it and hopefully we take advantage of it and not get scared away. So I
So
think
in risk management, that's called the moral hazard, which is
yeah,
carelessness. You do not take the proper precautions to protect your asset because the asset is not protected or
right.
insured.
Yeah. Well, for next week, I think our listeners deserve a little bit of dissection of some of the companies that Leon Cooperman or Lee Cooperman is invested in. This is not just saying that he would buy or what, but he's already invested in these stocks. So I think it deserves a closer look. Those stocks deserve a closer look. Well, Wowie, thank you
All right, Mark.
thank you so much for coming on. Listeners, that
Mhm.
does it for this episode of Mark Yu and Wowie Show. Send your questions or if you just want to say hi to the email markyowowieshow@gmail.com or tweet me at markyu_dpt. Remember, build that emergency savings and invest the rest for an abundant retirement. This is Mark Yu signing out.
And Wabi Santos signing out.